Hi, good morning everyone, and I hope you are all doing great. Thank you for taking the time to be here today. A little about myself. I'm Santosh Ashokan and I have been actively trading in the financial markets for nearly a decade, primarily focusing on index futures trading. In my trading, I use professional tools such as market profile, VWAP with standard deviation bands, and order flow dynamics using cumulative volume delta, with a strong emphasis on risk management. Recently, I completed my master's in global financial trading from Coventry University, where I further strengthened my quantitative and analytical skills. Today, I am grateful for the opportunity to share my intraday trading framework, which is built using market profile with day structures. Before we move into the detailed slides, let me briefly walk through the structure of today's presentation. First, I will explain why I have chosen the S&P as my primary asset class for intraday trading. Next, I will discuss the correlation between the S&P 500 and the Nasdaq 100, why tracking both indices helps in understanding overall market behavior. Then I will explain why my focus is on regular trading hours rather than the full extended trading hours, and how this helps in identifying better liquidity, clearer structure, and more reliable trade opportunities. After that, I will take about volatility preparation using ATR, which I use the pre-market session to set realistic expectation for the trading day. Moving forward, I will cover day structures and open types, especially the 6 types of day structures and the 4 types of open market opens, along with how I interpret initiative and responsive activity. I will then introduce market profile, its key terminologies, and how I use it to understand market behavior. Based on this, I will explain how I go about building market sentiment for the trading day. Following that, I will discuss opening price levels, balance and imbalance condition, and how I identify acceptance and rejections in the zones. Next, I will walk you through a structured trading approach, starting from pre-market session to all the way through to the post-market review. After that, I will share a real trade walkthrough demonstrating how all these concepts come together in live market conditions. Finally, I will conclude with a summary of the key takeaways and end with thank you. With that overview in place, let's now begin with the first session of the presentation, why I have chosen the S&P 500 as my primary instrument for intraday trading. If you look into the slide 3, the reason I selected the S&P 500 as my primary instrument for intraday trading is its exceptional liquidity. As shown in this slide, the S&P 500 is one of the top 3 most liquid futures contract traded globally, with approximately 1,800,000 contracts in a single day. This high volume means that it's very liquid and the bid-ask spreads are narrow, resulting in low impact cost. Additionally, because of this high liquidity, it's challenging for the large institutions to move the price significantly without deploying a substantial amount of capital. This stability helps in reducing volatility and provides more predictable trading environments. When you look into the next slide, I will consider the Nasdaq 100. The Nasdaq 100 has a strong correlation of about 92.5% with the S&P 500. As an intraday trader, I value volatility for capturing profit, and the Nasdaq 100, with its heavy tech stocks, tend to move more volatile, offering more trading opportunities. Now, when we look at the time frames, I focus on regular trading hours rather than extended trading hours, which is 9:30 to 4:15 US time and 2:30 to 9:15 UK time, New York session. During the regular trading session, approximately 80% of the volume is traded, whereas only about 20% occurs during extended hours. This concentration of volume in the regular trading session means better liquidity, tighter spreads, which is crucial for intraday trading. In fact, when we analyze the volume patterns and we see significant spikes during these regular hours, typically from 9:30 a.m. to 4 p.m. Eastern Time, this consistency in volume ensures that I can rely on the data and have more predictable price movements. Furthermore, when we look at the average true range over the past sessions, we can expect a typical price movements of around 85 points on an average during the regular session. If we look into the practical example in this slide, for instance, on a recent trading day, the price range was from 5742 to 5835, which means a 95 point move in that session. When we look at that average true range over the last 10 trading sessions, it's around 85 points. This means that on average we can expect about 85 points of movements in a typical intraday session. To put this in a perspective, compared to assets like Bitcoin, which can move thousands of points in a single day, the S&P 500's movements are more modest, usually in the range of 80 to 90 points. This helps set realistic expectation for intraday targets and stop loss levels based on ATR. Now that we have established our volatility expectations using ATR, the next step is to understand how the market is actually distributing price during the session. For that, let's dwell into the market profile terminology, which is crucial for interpreting my trading strategy. In this slide, I use a 30-minute candlestick time frame. Each 30-minute interval is represented by a TPO, or a time price opportunity, labeled from A for the first period, B for the second period, and so on. Throughout the entire regular trading hours, when we plot each candlestick as its corresponding TPO, we create what's called a split profile. For example, the first period A shows the initial range formed and the subsequent periods B, C and so forth continue to build upon that range. If we combine all these TPOs into one profile, we often get a bell-shaped distribution. This distribution may not be perfectly normal, but it will show a value area where the majority of the volume is traded, and low volume nodes as well, where there is a less interaction between buyers and sellers. From this unsplit profile, we can identify key levels: the days high and low, the value area low and high, and the point of control, which is the price level where the most volume occurred when we look at the profile. And also we consider three main interpretations: the initial balance, the range extensions, and the extreme. The initial balance represents the first hour of trading and is typically formed by retail traders. This initial range sets the tone for the day. As the session progresses, we observe how other timeframe participants such as institutions either extend the range or bring the price back into the initial balance. For example, if we see that after the initial balance, the price breaks out to new highs, that indicates buyer strength. Conversely, if the price is pushed back into the initial range, that indicates seller strength. Additionally, we look at extremes, which are areas where we see single prints on the profile. These extremes indicate where one side of the market was dominant and give us insights into future price movements. In summary, understanding the market profile helps us gauge the overall market sentiment and identify potential trade setups. It allows us to see where the majority of trading took place and where the less active areas are, guiding us on where to look for potential entries and exits. Let's begin by consolidating our understanding of the different day types. We classify day types based on the initial balance and the average true range. For instance, when we have a small IB, meaning that the first hour's range cover only about 30% of the ATR, we typically see 3 possible day structures on this particular small IB range. The 3 particular possible day ranges are trend days, double distribution days, and non-trend days. In a trend day, the market gradually moves in one direction, often extending the range throughout the day and closing near the high or low. In a double distribution day, we might see a trending move but with a consolidation period that creates 2 distinct volume areas. A non-trend day is characterized by price staying within the initial balance, indicating indecisiveness and sideways movement. Particularly before the Fed FOMC non-farm payroll news events, the pattern looks like a long trend day because the big players are not positioning and waiting for the news to come over so that they can jump into the trades. Then when we consider the ATR, if the first hour range covers about 50% of the ATR, we have a moderate IB, and this often leads to what we call a normal variation day or a neutral day. A wide IB where the first hour covers a large portion of the ATR suggests that the market has quickly observed a significant range, and this often leads to a balanced day with potential for mean reversion. When you look into this normal variation day, it looks like a trending on either side, and the IB high or IB low has been broken on either side. But on the neutral day, the IB is broken on both sides, but the trending might not continue. It will mean revert to the value area. So the best possible trading setup for the normal variation day is to go on breakout trading technique, whereas for the neutral day we can able to look for a mean reversion trading setup. Now we have a solid understanding of different day types such as trend days, double distribution days, and non-trend days, and how they are influenced by the initial balance and the ATR. We can further refine our trading approach by comparing these day types with the different open types. There are 4 primary open types: open drive, open test drive, open rejection reverse, and open auction process. Open drive occurs when the market opens and moves strongly in one direction without significant opposition, typically seen in trend days or double distribution days. This means the price keeps pushing in the same direction from the open to the close. On the other hand, open test drive happens when the market opens and then tests previous reference levels such as the previous day's high, low or value area. The price may briefly move into these levels and then reverse, often leading to a directional move as the market rejects those levels. On the other hand, open rejection reverse is when the price opens, tests the previous levels and initially accept it, but then the market reverses and moves away. This indicates a shift in control from one side of the market to the other. And when you look into the open auction process, it indicates a balanced market condition where the price opens near previous value area and trades within that range, showing equal strength from both buyers and sellers. By combining our understanding of day types and open types, we get more probabilistic view on the trading session. This helps us better anticipate potential market movements and choose the right trading techniques, whether it's a breakout strategy or a mean reversion approach. With this integrated approach, we can fine-tune our trades to match the market's behavior more effectively. Once we have this framework in place, comparing these day types with the open types gives us even more insights. For example, an open drive combined with a trend day often confirms strong directional movement, while an open test drive might indicate that the price is testing previous levels before choosing a direction. In summary, by combining the understanding of day types and open types, we enhance our ability to anticipate market behavior and select the most effective trading strategies. Once we understand the day structure and the open type, the next step is to evaluate where the market opens, specifically whether the price is in balance or imbalance. By balance, we mean that the price opens near yesterday's point of control, within the previous day's value areas, or within the previous day's range. In this scenario, we have three zones. Zone 1, opening near the POC. Zone 2, opening between the POC and the value area high or low. In Zone 3, opening between the value area high and the previous day's high, or the value area low and the previous day's low. In Zone 1, 2 and 3, the market is considered balanced. However, if the market opens above the previous day's high or below the previous day's low, we have an imbalance open, which is in Zone 4. In an imbalance scenario, there are two possible outcomes: acceptance and rejection. If you look into the acceptance, if the price opens below the previous day's low and remains accepted in that zone, it shows initiative activity and suggests that the imbalance will continue in that direction. Whereas in rejection, if the price opens in an imbalance zone but fails to sustain in that zone, it will push back towards the previous day's value area, indicating responsive activity and failed imbalance. Let's just move on to the market sentiment analysis. To build market sentiment, before the pre-market session, we compare yesterday's profile with the day before yesterday's profile, value area shift, range extension and extreme. When we look into the value area shift, which is mentioned as number 1, if yesterday's value area shifted downward compared to the day before yesterday, it indicates a negative sentiment. Whereas if you look into the range extension, which is mentioned as number 2, if yesterday's initial balance low was broken on the downside, it shows that sellers extended the range downward, indicating a negative sentiment, whereas the initial balance high is protected for the entire day. That's how the range extension is on the negative side. And finally, if you look into the extreme, which is number 3, if there are single prints or selling tails at the higher end of the profile, it signifies selling pressure and a negative sentiment, whereas if it is in the buying side, then it is an positive sentiment, buying pressure, which is not present in this particular profile. So combining these three aspects, value area shift, range extension and extremes, gives us a clearer picture of market sentiment. If all the three indicate negativity, we anticipate a bearish outlook for the day based on the past data. But we have to flexible enough to change our bias based on current day's developing value and sentiment by looking at the current day's activities. When we combine these insights with the day structure and open types, we gain a clearer understanding of market sentiment. If you look at this particular slide on the top right corner, for example, if the market opens above the previous day's high and try to fall back to the yesterday's range, but it doesn't sustain over there and even closed above the previous day high in the opening candle, it indicates initiative buying and imbalance acceptance. While if you look into the below right bottom one, even though the price opened previous day's high, but it fails to close above that level and even closed inside the previous day's range, which indicates responsive selling activity. By analyzing these factors, opening placement, market sentiment, and activity types, we can create a structured approach from pre-market session to post-market, which we'll go through in the following slides. In the upcoming slides, I will dwell into this structured approach in detail, examining each stage from 2 p.m. to 9:15 p.m. as per UK time in US session. I will also walk through a real trade example showing how I utilize my Excel sheet to calculate market sentiment, measure ATR, identify open types, and determine balance or imbalance conditions. This will give you a clear view of how these elements come together in practice. Let's dive into that structured approach and explore the real world application of these concepts. At 2 p.m., I conduct a pre-market analysis to gauge sentiment and the expected volatility, which I have calculated to be around 85 points in the beginning of the slides. Once the market opens at 2:30 p.m., I assess the opening zone and the open type by 3 p.m. Then I analyze the initial balance by 3:30 p.m. Based on whether the initial balance is small, moderate, or wide, I can identify the probable day structure and choose appropriate trading strategies such as breakout or mean reversion. Finally, at 9:15 p.m., after the market closes, I conduct a post-market analysis to review my predictions and refine my approach, and also to improve for the next trading day. This structured approach from pre-market to post-market ensures me to stay disciplined and well informed, ultimately leading to better trading decisions. With this structure in place, the next step is execution. Let's move on to a real trade walkthrough, where I will explain how I translate this analysis into decisions using my Excel journal. If you look at this Excel sheet, it serves as my execution and decision making framework. For example, let's consider this particular day. We have yesterday's profile and the day before yesterday's profile and the current day's profile, which is not yet open. At 2 p.m. UK time, I begin my process by focusing on pre-market analysis and market sentiment calculation. If you look at the top left corner of the sheet, you will see that I calculate market sentiment based on yesterday's and the day before yesterday's profile, considering factors like value area shift, range extension, and extremes. When comparing yesterday's profile with the day before yesterday's profile, the value area overlaps, which is shown as number 1 with white overlapped area, indicating a neutral sentiment. However, the range extension shows that the initial balance low was broken on this downside. The initial balance is nothing but first 1 hour range, that white line A and B period, that high IB high has not broken and it has been protected for the whole day. But if you look into the IB low, which I marked as number 2, has broken on the downside, indicating a negative sentiment. As far as extreme as concerned, both buying and selling pressures are present, so we consider that as neutral. Overall, the market sentiment is negative because the value area overlaps and also extremes are neutral, but the range extension alone negative on the downside. This analysis doesn't require today's profile data. Thus by 2 p.m. I have both the market sentiment and the expected volatility, which we have calculated to be around 105 points for this particular Excel sheet on that day. When the market opens at 2:30 p.m., we see that the opening is nearer the previous day's point of control, indicating a balance condition, which I marked as open. However, by 3 p.m., we notice that the market is rejecting the point of control and shifting from balance to imbalance, with a slight initiative selling activity occurring early on, and also it shows the open test drive open type, which also signifies an initiative and imbalance nature. By 3:30 p.m., after the initial balance is formed, we see that the range is about 48% of the ATR, indicating a moderate or medium initial balance. This suggests that the day structure could be either a normal variation day or a neutral day, which I have marked in orange line showing normal variation day downside. Given the balance to imbalance shift and the rejection at the point of control, the likelihood of mean reversion trade is lower, and the probability of normal variation day with a trend is highly possible. As a result, I look for short opportunity once the initial balance low breaks. On this day, I entered multiple short position as the price continued to trend downward. While one of my stops was triggered due to a tight stop placement, I adjusted my stop loss levels to improve risk reward, which triggered my SL instead of placing the SL in the previous reference zones such as value area low or point of control. But eventually the price moved favorably and I captured gains. Finally, after the trading session, I review my performance in the comment line, noting what went well and what could be improved. For instance, I might note that placing a stop loss too tight reduced the reward potential. On the positive side, I identified the shift from balance to imbalance early, even if the initiative selling wasn't very strong. This structured approach from pre-market to post-market allows me to refine my trading setup. Up to this point, we have thoroughly explored the entire structured approach from pre-market to post-market analysis. During this process, it's common to encounter challenges in identifying the shifts between balance and imbalance, as well as understanding how the day's value area develops. That's why in the following slides, I have incorporated the VWAP with standard deviation bands. If you look into this particular slide, in the first screenshot, we focus on the RTH anchored point, marking the start of the US session. From this point, the VWAP and value area zone develops, with the upper and lower bands representing the plus and minus 2 standard deviation levels. In this first example, we see the price retrace to the 1 standard deviation band and then revert back to the 2 standard deviation band, indicating a slight imbalance in the upward direction. In the second screenshot, we observe a VWAP downside rhythm, especially around the FOMC news event. Here, whenever the price approaches the VWAP, it tends to revert back to the minus 2 standard deviation bands, and this pattern continues until the news event triggers a significant downward move. This demonstrates that the market was already poised for a bearish move before the news release. In the third screenshot, we see a combination of balance rhythm during the first part of the session, followed by an imbalance towards this downside in the second half. Initially, the price rotates between the 1 and minus 0.5 standard deviation bands, and then after the lunch session it shifts towards the imbalance, consistently moving towards the lower bands. Finally, in the fourth screenshot, we observe a perfectly rotational rhythm where the price oscillates between the minus 2 standard deviation and plus 2 standard deviation bands, creating a stable mean reversion environment. It's important to note that while the VWAP with standard deviation bands provides valuable insight, it should not be used in isolation. We must combine it with our comprehensive market profile approach, which we have developed from pre-market session to post-market analysis. During the trading session, particularly around 3 p.m., we will use the VWAP as an additional tool to help identify shifts between balance and imbalance. However, it's crucial not to rely solely on the VWAP. By integrating it with our market profile insights, we ensure a well-rounded and robust understanding of market condition. In the next slides, we will dwell into order flow dynamics and cumulative volume delta for even deeper insights, which gives us an extra edge. With that established, let's now dig deeper into order flow dynamics combined with the depth of market and cumulative volume delta, which will give us even sharper insights. If you look at this slide, you will see the distinction between a candlestick chart and a footprint chart. While a candlestick might show a large green bar, it doesn't reveal the nuanced interaction between buyers and sellers at each price level. That's where the footprint chart or order flow comes into play. Simply looking at the candlestick can be misleading. A large green bar doesn't always mean buyers are in control. The real dynamics are revealed through order flow. For instance, in this footprint chart, we can see how many contracts were traded on the bid versus the ask, revealing the intensity of buyer and seller activity at each price level. However, even the footprint chart alone doesn't fully capture the market sentiment. To gain a deeper understanding, we combine it with depth of market or the order book, which provides additional layers of insight. For example, in the following slide, we will look at a short video illustrating how aggressive buyers might be getting trapped by passive sellers using iceberg orders. This allows us to see the true strength of sellers and the potential traps for buyers. If you look at this particular slide, I have attached a short 2-minute video of depth of market with level 1 data for the US Treasury 10-year yield. I chose this asset class because it's more stable and easier to explain compared to something like E-mini S&P, which can be very volatile. For instance, at the current price level of 136.22, there are about 498 passive sell orders in the limit order book, and at 136.2150 there are about 211 passive buy orders initially. There are no aggressive orders present right now. The red column represents passive sell orders and the blue column represents passive buy orders. Aggressive orders will appear in the white zone once we play the video in the center part. As we watch the video, you will notice that at the level 136.22, aggressive buyers come in starting with 100 contracts, then 200, 300, 600, even 1400 and up to 2000 contracts, all bought at that price level. But despite this large buying volume, the price doesn't move up even a single tick. On the other hand, on the passive sell side, we see large absorption, although initially 2000 contracts and later again 2400 2500 contracts, nearly 4500 contracts are sold in total. the price never moves beyond a certain level. Each time 300 or 400 contracts are observed, sellers reload the order book with another 300 contracts, demonstrating the iceberg order pattern. After the iceberg orders, if you look into the right side of the chart in this video slide, I have included a goal chart just to illustrate the absorption example. Even though the cumulative volume delta is increasing on the upside at the bottom of the chart, however, on the upper part of the chart shows the price which remains at the same level. This is a classic absorption scenario, much like what we observed with the US Treasury yield. In the next paragraph or the slide, we have shown the delta divergence, where we can see that there are 4 types, 2 representing lack of participation on the buy side and the sell side, and the 2 representing absorption on the buy side and the sell side. Previously, we have seen a classic example of the 4th type, where price makes lower tops or staying at the same level, while the cumulative delta makes higher tops, indicating that buyers are getting trapped. While we focus on this absorption example, it's important to note that the other types of divergence also exist, and we have not gone through each of them in detail here. In the slide about the limit order book, it's a bit more complex, and high frequency traders use level 2 and level 3 data, often visualized in heat maps and bookmarks, which is shown here. This level of detail is typically used by large institutions, and as retail traders, we don't really always have access to that level of data. Still, we can gain significant insight from level 1 data, combining with market profile and cumulative volume delta, which we have seen. Finally, when we look at individual session profiles and composite profiles, along with price with standard deviation bands and VWAP, combined with cumulative delta, we see that even without level 2 and level 3 data, we can still have a significant hedge. This holistic approach helps us understand market dynamics more thoroughly and provides a robust framework for making informed trading decisions. In conclusion, this comprehensive approach, combining market sentiment, market profile, order flow and cumulative volume delta, provides a solid framework for understanding market dynamics. It allows us to define dynamic support and resistance levels using VWAP and filter out false signals and make more informed trading decisions. With my 10 years of experience in the financial markets and having navigated through significant losses and learning experience, I have shared my overall insights in detail over the past 40 minutes. I truly appreciate your time and attention and the opportunity to share these valuable insights. I hope you found them as enlightening and beneficial as I intended them to be. Thank you.